2022 was a wild year with some crazy real estate headlines. To sum it all up, the first third of the year was insanely hot, and even with the first 25 basis point rate hike, the market still wasn't backing down. But once more people realized how serious rate hikes might get in April, things quickly flipped upside down for the rest of the year. Nobody knows for sure what 2023 might bring, but we do expect more predictability relative to 2022. So what do we expect for 2023? Well, stay tuned, but before I do, check this out. This is a heads up that you can get our complete Toronto real estate investing guide for free on our website. You can see things like a breakdown of typical costs, rents, appreciation, sample financials that you can change up to see how it affects your returns, and even try out a quiz to see what might fit you best. I'll put a link to the free guide in the description below. Don't forget to like this video and subscribe to our channel so you don't miss other content like this made just for real estate investors in Toronto. Let's take a look at what's happened so far. Here I stack the annual price of 416 detached homes with their monthly prices since 2015. The macro trend is that real estate prices have been going up on an annual basis, and 2022 follows this trend. But this undermines the craziness that went on in 2022. The reality is that prices actually went up 21% from the 2021 average at the peak in 2022, and then ended 9% lower than the 2021 average. And so the peak to trough difference was an insane 37% within 1 year. The good news is that conditions are expected to be more stable than that for 2023, but it doesn't really mean much if 2022 was actually that crazy. But also because of that, 2022 isn't a very good year for us to compare and contrast with. So let's go further back and try to figure out what 2023 might mean by comparing it to 2021 instead. The big plus was that rents rose, which benefits rental properties. Freehold rents went up 20% and condo rents went up a bigger 24%. On the flip side, inflation drove interest rates and mortgage payments up too, which is obviously the big negative. Average mortgage rates were around 2% in 2021, but now fixed rates are closer to 5%. And so that would be a 45% increase in payments if the purchase price stays the same. Home operating expenses are also up. And according to inflation numbers, shelter is up around 7% from 2021. So yes, big expense increases do mean prices still need to come down. But the obvious difference is that rental properties will be in a much better position compared to end user homes. Take a look at this. For house investments, prices would need to come down by a lower 10% compared to 2021 average prices to see similar cash flows because of an increase in rents. Now let's take a look at condos. For condo investments, even though rents did come up higher, they do have a bigger expense ratio compared to houses, and that actually ends up weighing more on the cash flow situation. And because of this, prices might need to come down more by 14% from 2021 average prices to see similar cash flows again. The biggest downside impact definitely goes to the end user homes, and math here tells us that prices need to come down by 30% from average 2021 prices to see similar affordability compared to before. But even if the price is right, the other part that's going to cause more divergence in real estate markets come from access to credit. Because credit is tightening, there will be a drop in demand from real estate investors because fewer people can qualify. And even if they do, home prices are simply not there for refinancing to buy. From the end user side, luxury homes will probably be dragged down the most because of the same reason. It's just harder to get a big enough mortgage for people to buy properties that need a bigger mortgage. So as you can see, these factors will mean more diverging market trends ahead. The markets that will recover the fastest will be very demand dependent. Demand for investment properties will come more from those who have stronger income ratios and can qualify for more mortgages. And most of the time, these investors' preferences will be for safer investments with a better balance of cash flows and appreciation like freeholds over condos. And for end users, demand will probably funnel more so into starter home types because first-time home buyers are the most likely ones to be able to buy. They have the least outstanding debt to begin with, and so they can actually borrow more money. Purchase prices and mortgages are lower here. Plus, the barrier to entry is also lower because it's actually possible to go with a lower down payment if they choose a CMHC mortgage. And soon, more Toronto houses are going to qualify for this because they're going to dip under the $1 million mark, which is the requirement for CMHC mortgages. So while it's true that 2023 might open up more opportunities, it's not a simple decision at all because real estate will not all be moving in the same direction and will also not be recovering at the same pace. But that's precisely where we come in. If you need help planning out your 2023 Toronto real estate investing roadmap, including where and when you should be buying or selling, we're ready to help. We're a real estate sales brokerage that focuses on investing in houses and multifamily homes in Toronto, and here's how it's like to work with us. First, we'll do a discovery call with you so we get to know each other more and help you get your financing ready, and then we'll teach you how to analyze deals. Once you're set, our sales team will work with you to find the best opportunities on the market and eventually help you buy the best one for you. Houses typically need a bit of renovations and will help you with a detailed scope of work and contractor connections. And then once you're ready to rent out the place, we also have leasing and property management services if you need it. So if you want to learn more about any of this, just head over to our website at the link down below. Again, don't forget to give this video a thumbs up and look for us on Facebook, Instagram, or LinkedIn if you want to hear from us more regularly. You can also head over here to check out our other videos. Thanks so much for watching and see you in the next video.